Polestar, the electric vehicle maker once hailed as a strong contender in the EV space, has just reported a massive loss for the second quarter of 2025. This isn't just another earnings miss. This is a warning shot across the entire EV industry. In this video, we're breaking down why Polestar lost over $1 billion, how US tariffs and pricing pressure are squeezing EV margins, and what this means for the future of electric mobility, startups, and consumer demand in both the US and Europe. Let's get into it. Polestar posted a net loss of $1.03 billion for the quarter ended June 30th. That's nearly 4 times larger than its loss of $268 million during the same quarter last year. So what happened? The short answer: tariffs, pricing pressure, and a brutal reality check. One of the biggest hits to Polestar's financials came from an impairment charge tied to its flagship vehicle, the Polestar 3. Facing an uphill battle from newly imposed US tariffs and sagging demand, the company slashed the recoverable value of the Polestar 3 to just $25 million. That resulted in a staggering $739 million write-down, effectively acknowledging that a major part of their product line is worth far less than they originally thought. To put that in context, this isn't just an accounting adjustment. This is a sign of real-world weakness in demand, pricing power, and manufacturing feasibility. So what triggered all of this? It all ties back to the tariffs. The US has enacted a new wave of import tariffs targeting foreign-made EVs, part of a broader trade policy shift under President Trump's second term. These tariffs have disrupted global supply chains, forced automakers to rethink production hubs, and made it significantly more expensive to sell foreign-made EVs in the American market. Even though the Polestar 3 is built in South Carolina through Volvo Cars, which also owns a stake in Polestar, the economic pressures and logistical hurdles from tariffs have had ripple effects across their operations. Volvo itself recorded a similar impairment charge related to its ES90 and EX90 electric models, citing the same mix of tariffs and launch delays. But it's not just tariffs. Polestar is also facing relentless pricing pressure. The EV market, especially in North America, has become brutally competitive. Legacy automakers like Ford, GM, Toyota, and Honda are leaning into hybrids and gas-powered models again, offering attractive pricing and longer ranges. And Tesla continues to undercut rivals with strategic price drops that force other EV makers into difficult decisions. In this pricing war, Polestar has struggled to keep up. They've implemented discounts and offers in Europe to help boost flagging demand, but those strategies haven't had the same effect in the United States. In fact, US sales in Q2 dropped 56% year over year. That's right, more than half of their US customer base vanished in a single quarter. Meanwhile, the company is under extreme financial pressure. At the end of Q2, Polestar had $719 million in cash, slightly down from $732 million in the previous quarter. But that number doesn't tell the full story. Polestar has been burning through cash at a dangerous rate. In a telling move earlier this year, the company handed over 177 vehicles to lenders as collateral to secure a financial deal. A desperate but not uncommon tactic for capital-starved companies. These types of moves aren't just red flags. They're flashing warning signs for investors, suppliers, and the broader market. Polestar is trying to hold the line where others have failed. Let's not forget, Fisker, Lordstown Motors, and Arrival have already collapsed after running out of cash, and other players are barely holding on. So what's keeping Polestar afloat? The company secured a $200 million equity injection from one of its major shareholders, PSD Investment, in June. That investment bought them some time, but it's not a long-term fix. Without a significant turnaround in either sales or profitability, the runway is short. And with rising interest rates, tougher competition, and tariff-induced cost pressures, scaling profitably has never been harder. There's also a brand perception issue. While Polestar positioned itself as a premium EV brand, sleek design, minimalist interiors, and high performance, the EV buyer landscape is shifting. Many consumers are no longer looking for luxury-first electric vehicles. They're looking for value, reliability, and affordability, especially as inflation continues to squeeze wallets. And in this new reality, Polestar finds itself caught in the middle. Too premium for budget-conscious buyers, yet not distinct enough to justify a luxury price tag in a saturated market. Let's talk about global trade tensions and how that's affecting strategy. In response to the US tariffs and the resulting uncertainty, Polestar has begun reworking its supply chain, exploring more localized manufacturing options, and reducing exposure to US-China trade volatility. But supply chains don't evolve overnight. It takes years and billions of dollars to move production, qualify new suppliers, and pass regulatory hurdles. Polestar doesn't have the same level of financial flexibility or geographic diversification as industry giants like Tesla or Toyota. That puts them at a distinct disadvantage. So what happens next? It all comes down to three things. Can Polestar cut costs fast enough without sacrificing product quality or brand identity? Will demand for premium EVs rebound in key markets like the US and Europe? And most importantly, will the company secure enough capital to survive the next 12 to 18 months? The company's current financial position is fragile, but not yet terminal. They've got some cash, they've got a shareholder willing to keep them alive, and they have a recognizable brand that still carries weight in Europe. But time is running out. Final thoughts. Polestar's Q2 results aren't just a bad quarter. They're a reflection of a larger crisis unfolding across the electric vehicle industry. From tariffs and pricing wars to debt, demand shocks, and changing consumer behavior, the EV space is under pressure like never before. Polestar is fighting for survival. Whether it joins the growing list of failed EV startups or finds a way to adapt, depends on what happens in the next few quarters. One thing is clear, the electric vehicle revolution isn't going to be easy, and it's not going to be cheap. Thanks for watching Finance Spot. If you found this video helpful, make sure to like, subscribe, and turn on notifications for more breakdowns on the biggest stories in finance, markets, and innovation. Drop a comment below. Do you think Polestar can bounce back, or are we watching another EV startup collapse in real time? We'll see you in the next one.